Welcome to the Explainer. Today, we're unpacking a highly complex web of global events and financial metrics to figure out a massive vulnerability that's currently hanging over the markets. We are going to look at the whole picture, everything from geopolitical tensions halfway across the globe, all the way down to the micro-technical structures of the Nasdaq. And look, we aren't here to take political sides or pretend we have a crystal ball. We are strictly analyzing the data, the charts, and the established macroeconomic forces currently at play. So ask yourself this, could the entire market fold from a single geopolitical spark? It's really easy to look at a booming tech stock and think, hey, I'm insulated from global conflict. But today, we're going to see how incredibly interconnected global supply chains, government reserves, and stock chart technicals actually are. Because honestly, one fallen domino in the energy sector could rapidly trigger a chain reaction that hits the specific stocks sitting in your portfolio right now. Okay, here is our roadmap for today. First, we'll cover the fragile market setup. Second, the straight and the squeeze. Third, the bearish combo. Fourth, institutional hedging in AI. And finally, number 5, we'll dive into the critical levels to watch on the charts. Let's get right into it. Section 1, the fragile market setup. We have to begin with the very first domino in this chain reaction, the underlying macro catalyst. Our analysis starts right at the Strait of Hormuz. Right now, there is a ton of intense, conflicting geopolitical noise surrounding this critical shipping lane. You have the US saying the strait is open to commercial traffic, while Iran has announced it's closed. But here's the absolute crucial takeaway for the markets. Regardless of what the official status is, commercial ship traffic is naturally stalling. Companies are just holding their vessels back to mitigate the physical risk of an attack. And as you probably know, financial markets don't wait for the oil to actually run dry. They start pricing in the disruption long before physical oil shortages ever hit the mainland. Moving right along to Section 2, the straight and the squeeze. Let's look at what this anticipated disruption does to global oil supply and government reserves. 10 to 15 years. I really want that number to sink in for a second. Right now, the Strategic Petroleum Reserve in the US, and honestly, reserves in places like Japan, Australia, and across Europe too, are sitting at critically low levels that we literally haven't seen in over a decade. For a while now, governments have been flooding the market with these reserves to keep oil prices artificially low. But, well, they've essentially spent all their ammunition. And that brings us to a highly dangerous setup, the forced replenishment squeeze. Because those reserves are at 10 to 15-year lows, governments have completely lost their price suppression power. Eventually, they have to flip. They have to transition from releasing oil to actually buying it up to refill those empty tanks. Now imagine introducing massive government buying pressure into a market that's already panicking about supply disruptions in the Straits of Hormuz. You get a violent squeeze that just naturally blasts prices higher. Now, what's really fascinating here is how the market digests these price hikes. If oil goes on a slow, gradual uptick, the market can usually handle it without totally freaking out. But, and this is a big but, if that forced replenishment squeeze hits during an active conflict, we are looking at a rapid, sudden spike right back to that $80 to $90 per barrel range. The speed is the killer here. A rapid move to $90 causes sudden volatility and sends widespread shockwaves across major indices, like the S&P 500. Section 3, the bearish combo. Let's see how these energy shocks act as the next falling domino for the broader economy. Analysts call this specific setup the bearish combo. It's exactly what it sounds like, the simultaneous occurrence of a sudden oil shock combined with sticky core inflation. Think of it like a giant pressure cooker. The underlying costs of goods, that sticky core, just refuses to go down. And then suddenly, the cost of the energy required to literally manufacture and transport everything shoots through the roof. It is an unbelievably tough environment for any market to navigate. And as you might guess, this bearish combo creates an absolute nightmare for the Federal Reserve. Spiking energy costs throw a massive wrench into their inflation management. You know those recent good CPI prints we saw? Well, they might actually be a bit of a mirage if they only happened because oil prices were being temporarily suppressed by those shrinking strategic reserves. If inflation stays hot because of energy spikes, the Fed is almost certainly going to stay hawkish. No rate cuts anytime soon, and that reality heavily ramps up aggressive sell-side pressure on the stock market. All right, Section 4, institutional hedging and AI. How is the smart money positioning itself with all this fragility out there? Take a look at this. Notice how tech and energy are basically flying upward together right now. Normally, you just don't see these two distinct sectors moving aggressively higher at the exact same time. Tech and AI stocks have obviously been doing the heavy lifting for the indices.
But totally under the radar, energy stocks are crushing it too. This dichotomy is a glaring signal. Big money institutions are hedging their bets. Sure, they're riding the tech wave, but they are aggressively buying energy infrastructure to protect themselves from the exact macro domino effect we're talking about.
The crucial takeaway here is perfectly summed up by this visual. Right now, the market is balancing on a tiny, narrow sliver of AI and semiconductor stocks. But if those macro pressures, the oil shocks, the inflation, the hawkish Fed, cause that narrow leadership to finally buckle, the whole structure comes down. If the entire house is on fire, most of the stocks inside the house are going to burn with it. You just can't assume your non-AI stocks will magically climb if the heavy lifters roll over. Actually, we're already seeing the warning lights flashing red with several risk-off indicators. Outside of that super narrow AI leadership in funds like the SMH and QQQ, the broader market looks pretty exhausted. The Dow Jones has seen its upward momentum dramatically hit a wall, and look at the Russell 2000, ticker IWM. That's our gauge for small caps, and right now it is vastly underperforming, stuck way below its all-time highs of 302. When the small guys can't join the rally, it's a massive glaring warning sign. Which brings us to Section 5, Critical Levels to Watch. Let's ground this macro theory into the actual chart technicals. Let's put some concrete numbers on this anxiety. Looking at the S&P 500 through the SPY ETF, it actually looks somewhat decent for now. If buyers can push it above the 756.6 resistance level, we could see new all-time highs. But its major support floor is way down at 731.9. If that breaks, watch out below. Now, the QQQ, the tech-heavy Nasdaq, is where we're really focused, especially with AI wavering a bit. We're watching support at 722. But if the QQQ loses its absolutely critical level of 74.5, things are going to get very ugly very fast. On the flip side, if the bulls step up, there's a gap fill waiting to the upside at 736. Zooming in on the Nasdaq using Elliott wave analysis gives us a bit more perspective. After that monster rally we had from March to June, the index has basically just been chopping sideways. In this framework, we're currently in a wave 2 consolidation phase. And honestly, this is important to remember. Consolidation isn't inherently bearish. The market is essentially just taking a breather. It's trying to process all this conflicting macro data and waiting for a clear, directional breakout before it decides to either resume the rally or trigger a deeper correction. And for those of you trading the short-term intraday moves on the Nasdaq futures, let's break down the microstructures. Your very first micro support zone sits between 29,163 and 29,623. Immediate resistance overhead is right between 29,944 and 32,282. If we drop below that support, that's your first clue the bears are grabbing the short-term wheel. But the absolute line in the sand, the level that completely invalidates the bullish setup, is a drop below the recent swing low at 28,932. So we've traced the whole web today, from ships stalling in the Strait of Hormuz, to drained government oil reserves, to sticky inflation, all the way down to the micro levels on the Nasdaq charts. So let's wrap up with one final thought. Look at the data we've unpacked today and ask yourself, if the AI engine driving this whole market stalls out, and those institutional energy hedges are triggered by a sudden supply shock, are your investments ready for the dominoes to fall? Understanding this setup is step 1 to making sure you aren't caught off guard. Thanks so much for joining me for this explainer, and as always, keep your eyes on the data.